Well, effectively there's three risk areas that have been identified in practice. The first one is that most entities are trying to accommodate the post-March 2002 adjustments to packages, where effectively the only structuring technique available is a travelling allowance. In the same aspect, by the inflationary costs that are incurred, it's easier to structure a travelling allowance where the individual gets some kind of tax relief versus an increase in package. The other aspects we're finding as an issue is those relating to grading systems, where parties are allocated a specific travelling allowance based on grade. And the third aspect is where people are effectively removing travelling allowances based on SARS's effective marketing campaign saying if you're not travelling for business, i.e. you're not entitled to claim a travelling allowance.
So Steve, what are the requirements for a valid travelling allowance?
First aspect is the travelling allowance has to be part and parcel of the individual's job description. So in other words, by having it as part and parcel of job description, you're automatically referring to the letter of appointment. If the letter of appointment does not stipulate that person X is required to use their own private motor vehicle for business purposes, and as such they pay them a travelling allowance to defray the costs they're going to incur while operating for business purposes, SARS could disallow the allowance. The second aspect to that is effectively that the travelling allowance has to be realistic. You know, in a lot of instances you find an individual for the last 3 years have submitted on their tax return that they've done a total of 20,000 kilometres for the year, but when the package is structured they are reverting back to the 32,000 Dean principle. So it's important to ensure that one, a travelling allowance is allocated correctly, number two, that it's in conjunction with what the individual is effectively travelling for that specific year.
Okay, now what is the significance of the grading system?
The grading system is a system that has been brought in from a human resource perspective. It's a fair basis equalization format where individuals within different job positions are graded accordingly. But the problem that you have with that is you would have a scale of an individual on a grade 1 across the board that might incorporate somebody from a marketing department, for example, and somebody from the accounts department. Now, based on that, they would automatically receive the same travelling allowance. But from a realistic point of view, the party that's sitting in the accounts department is less likely to do any business travel than the person with regards to the marketing department. So needless to say, SARS is aware of this aspect, and effectively they require the companies to substantiate.
So is it advisable for companies to remove travel allowances?
Well, you have a catch-22 situation. If the individual staff member is in exactly the same position as they've been for the last 3 years, no specific or fundamental changes have happened to their job description, by the removal of the travelling allowance in the current year, it can be tantamount to the fact that the individual was not entitled to the allowance in the first instance, which meaning that the declarations not only made by the company in terms of the last 2-3 years, but also the individuals could be under scrutiny by SARS. In those instances, it's recommended that companies actually look at the amount or the value of the travelling allowances, reduce them accordingly. There's nothing preventing from a company from taxing in agreement with the individual the full travelling allowance, effectively allowing the individual then, if they have done any business kilometres for that specific year, to submit that on their annual tax return. People are trying to remove travelling allowances because the market perception of a deemed 32,000 kilometres I think has been in place for many, many years, but now people are reverting back to actual kilometres, looking at the odometer readings, determining what the actual business and private kilometres for the year was, and in that instance are resulting in having large assessments issued. And obviously we don't like to pay more than we have to, but from a cash flow perspective, a normal salaried person would prefer to have it on a month-to-month basis.
Steve, can you just tell us what risks, if any, are associated with payments made for fuel maintenance and reimbursements?
What we're finding is that, once again, a travelling allowance is a structured fixed amount. That is normally sent across to the relevant payroll department. They load it onto the system and it runs for the year in place. What happens though is that the fuel costs that are paid by accounts departments and other relevant exercises are not really always reported onto the IP5, which is a requirement. Anybody getting a travelling allowance, doesn't matter if you're paying them a fuel cost, for petrol cost, whatever it may be in that aspect, needs to be added to the travelling allowance.
Okay, thank you very much, Steve. That was most informative. And if you need any further information about this interview, please take a look at the next issue of Tax Talk magazine, or you can contact Tax Talk on 011 476 5048. Until next week, goodbye.